Hey, you ever heard of Bitcoin? Well, in today's video, I'm going to be going over the simple strategy, the simple techniques to buying in Bitcoin, liquidating everything you own and just going full straight into the market. You'll be rich within 6 months. So if you're in for that kind of content, then stay tuned. Hey everyone, how's it going? No, I'm not going to be talking about Bitcoin today, but I'm just going to be talking about general investing and answering the question, what is investing? Now, I hate to use this analogy, I feel like I say it a lot in my videos, but when I was younger, I just kind of assumed that the way people made money and the way people got wealthy, I guess, is just by having a high-paying job like being a doctor and then putting all that money away in the bank account. But when I started learning about investing, I realized that, it could be a little more complicated than that. And there are a lot of ways that people can actually increase the speed at which their money grows. I'm sure you've heard the common phrase, it takes money to make money. And I always heard this as a kid, but I really started to understand it when I started learning about what investing is. It takes money, of course, to make more money, because the more money that you put into an investment, in this video we're going to be talking about stocks, but generally the more money you put into any investment, generally there's a higher return there if it's a safe investment. While putting money away in a savings account is a really smart idea to do, something you should really follow through with, I started to realize, when I learned a bit more about investing, that there are way faster ways to grow your money, not just the 0.5% from the high yield savings account, not just the interest that the bank pays you, but actually using that money to invest in the stock market. So what is investing? Well, you can think of investing like this. Investing is when you take money like this and hand it over to a company so that they can use your money to help grow their business. You can consider it a little bit like a loan. And in return for this investment in them, they issue you what they call a stock to their company or a percentage of ownership. So for instance, if you have stock in Coca-Cola, you can walk into a supermarket and be proud that you see your brand because you partly own that company now that you've bought a stock from them. And this is where a fundamental of business comes into play. You hear the term, it takes money to make money. Well, this company hopefully takes your investment to help broaden their exposure to opportunities. So they take your money and hopefully use it to grow their business. And as they're growing in business, the value of their company goes up, meaning your stock or your percentage of the company goes up in value. And this is where you see the value of the stock market and the value of individual stocks grow over time. It's the value of the company growing. And this is where it gets exciting because hopefully you've invested in the right company that uses your money as a tool, that uses it correctly and grows their business over time. So let's open up Robinhood right here, which is a brokerage account that I use. And let's look at a company we all know, Amazon. We'll go out 5 years. So if you purchased a stock of Amazon 5 years ago, it would have been approximately $600. And now you look at the stock, it's gone up and up and up and up. And now one stock that you purchased for $600 is now $3,000. That's 380% gain. However, it doesn't always look like that. And I do want you to be sure of the downside. We can look at a company that we all knew of and we all still know of, probably, called GoPro. Now, GoPro was really popular back in the day, but I don't know, I feel like they're not as popular now. And you can definitely see that in the market. There was a drop over a 5-year period. So say you bought a stock of GoPro 5 years ago at $20, and that stock now is only worth about $6 or $7. So you also can lose. If a company decreases in value over time, then that means your stock decreases in value over time. So it's not always a guaranteed win. It may feel like betting, but it doesn't have to feel that way because what I'm about to introduce to you next is going to ensure that your money is always going up in value over the long period of time. And this is by investing in index funds. Now, an index fund you can think of like a basket of companies. When you buy a share from an index fund, the money that you use to purchase that share goes into this basket and then gets distributed to all the companies in that index fund. For instance, there are index funds that mirror the S&P 500, which is the top 500 most valuable US companies. So when you buy one share of the S&P 500 index fund, then that share gets distributed between all 500 companies. And this is what makes it a safe investment, is you're no longer worrying about, oh, is this company Amazon or is it GoPro? Is it going to go up in value or go down in value? You're not talking about one company here, you're talking about 500. And there are even index funds that composite the whole stock market. There are a lot of index funds out there. See, within an index fund, a company can go bankrupt or win big, and the index fund wouldn't really care much either way. It's going to stay pretty steady because the fund has the weight of all of the companies. And by diversifying your investment, by diversifying your interest in all of these companies, you're minimizing risk. I'll show you what I'm talking about. I'm going to pull up a popular index fund, VTI, which is Vanguard's Total Stock Market Exchange Traded Fund. Now, it doesn't look like it's doing too hot right now, but we can go up to the 5-year. And this is really what we care about because index funds are meant for long-term investment. They're meant for, putting your money in, holding it there for 10, 20, 30 years, right? But you can do whatever you want with it, but that's usually how it goes. Now, you can see the trajectory of the index fund here. I mean, it's gone up over the past 5 years. We can look at another one, VOO, which is Vanguard's S&P 500 ETF. And over time, still, same thing. It's going up and up and up over time. And you can look up numbers. Historically, an index fund has never decreased in value over a 20-year period. It's always gone up. I like to think of it as investing into the total economy. And when you ask yourself, is this index fund going to go up over time? You can look at what kind of things are in that index fund. And if it's split between 500 or 1,000 companies, I mean, that's the economy. Those are all the companies that are around us. That's Coca-Cola, Tesla, Apple, Microsoft. They're all companies that hopefully are going to keep building and growing in our economy. So when I'm buying into an index fund, I like to think that I'm buying into the idea that the economy is going to continue growing over time. And statistically, the economy has always grown over time ever since the Industrial Revolution because more people are being born and more businesses are being started and everything's going up and up and up and everything's always increasing in value in the stock market historically. So I'm not buying into the idea that, one company is going to succeed over the other. I'm buying into the idea that generally over the spread of the index fund, most companies are going to succeed. I think graphs give a great visual. So let's look at the S&P 500 annual return. And this breaks it down year by year from 1960 to 2020. And we can see that some years are really, really positive and other years are kind of falling short. You can see a market crash here and you can see a market crash here. And definitely the market crash that just recently hit us in 2020. But generally, there are more good years than bad years. So this is generating a 7 to 8% return every year. And that's great. There are good years where your investment goes up in value and then bad years where your investment goes down in value. But generally, the investment is going up more than it's going down. So you see the 7 to 8% return. I'm going to pull up an investment calculator so we can see the power of compound interest. Okay, starting out at $1,000 after 45 years at a return of 7% and no additional contribution. We're going to calculate this. Over 45 years, you'll end up with a balance of $21,000. That's 21 times what you started with. And that just has to do with the compound interest. It's 7% the first year, but it's also 7% the second year. So it's $1,000 and then $1,070 and then $1,145 and then $1,225. So it's not just increasing by $7 every year. The 7% is getting compounded and eventually it makes for some pretty big returns. So I would think that it's a pretty safe bet. It's not just a bet on one game of basketball, it's a bet on the total economy going up over time. And I'm pretty sure that it's always going to go up over time. Okay, everyone, thank you so much for watching this short video. I had a lot of people asking me if I could make a video explaining in simple terms what an index fund is. If you like this video, please give it a like, please hit the like button and hit the notification bell. I post really frequently, so be sure to, get alerted when I make the next video. And for the next video, I'm gonna be talking about why keeping your money in your bank account is a bad idea. So click that notification bell to stay tuned and get alerted when I post that video. Thank you everyone so much for watching and have a great day.